Hello everyone, this is the part 2 of chapter number 9, CMT level 2, volume and breadth. Before watching this video, make sure that you've checked the part 1 of this chapter. In case you haven't, then you can check the description box below. And also make sure that you watch the previous chapters. I've given the link in the description. So we're continuing from where we stopped. So we stopped near this. Yeah, so we discussed this. We have to start from Asprey's demand oscillator. So let's see what is Asprey's demand oscillator. Using direction to separate volume into two series of buying pressure and selling pressure, Asprey then nets them into his own demand oscillator. So like we've studied about the buying pressure and the selling pressure in the previous part, Asprey's demand oscillator basically uses the same concepts which we have discussed earlier, and he has created his own demand oscillator. Note that during a rising market, the selling pressure has been divided by a percentage of the volume, which has been scaled to be greater than 1. The following calculation, okay, let's just mark this down because this is important. Rising market, selling pressure has been divided by a percentage of the volume. So selling pressure in a rising market, selling pressure is divided by volume to give a percentage that is greater than 1. For rising prices, buying pressure is equal to VT. For selling pressure, we have VT divided by K multiplied by CT minus 1 upon CT minus 2. For declining prices, we have the buying pressure, and that is going to be the VT divided by K multiplied by CT minus CT. Okay, so that's the formula of the Asprey's demand oscillator. You just need to know that it's divided by percentage, and you need to be able to identify it if it comes in the MCQ. You won't be asked to fill in the formula, but they will give you the formula and they will ask you to circle the correct answer. So you just need to know how, see, you just need to know how they are calculating it. So the moment you see this, you know that they're talking about Asprey. Now let's talk about what exactly is K. We have seen that we have been multiplying K, right? So before that, you need to know that the demand oscillator is basically the difference between the buying pressure and the selling pressure, and the buying pressure and the selling pressure have been calculated in the formulas which we saw. So K is basically a scaling factor, okay? And that scale, what does it scale? It scales the volatility that is there in the market. K is a volatility scaling factor that is 3 times the closing price divided by the 10-day moving average of the maximum 2-day high or low combined range. So basically, just a second. Okay, yeah, where were we? We were here. Yeah, K is a volatility scaling factor, okay, and that is 3 times the closing price divided by the 10-day moving average of the maximum 2-day high low combined range. All right, so again, K is the volatility scaling factor, and it is 3 times the closing price divided by the 10-day moving average of the maximum 2-day high low combined range. And likely, most likely, the value of the K is always greater than 100. So that is one thing you need to keep in mind. It is usually greater than 100. For example, if the S&P is trading at 1000 and the average volatility is 15 full points, which is very high for a 10-day average, then K is basically 3000 divided by 15. Okay, that's literally what we just read. Now let's see, so that's what is Asprey demand oscillator. Now let's go and see what's tick volume indicator. Tick volume indicator is basically similar to RSI, like just like how we saw what RSI was in the previous chapter. It is very simple, but Blau double smooths the tick volume as a way of confirming the price direction. So the values are just double smoothed. Instead of smoothing it just once, they are smoothed twice. And the tick volume indicator is 100 multiplied by DMA minus DMA divided by DMA plus DMA. Now the first DMA is upticks, the second DMA which you are subtracting is downticks, and again upticks, downticks. Tick volume indicator is equal to 100 multiplied by DMA upticks minus DMA downticks divided by DMA upticks plus DMA downticks. Okay, and let's look at the DMA indicator. This is the tick volume indicator, like you can see over here, and various values have been taken into consideration in the first graph and the second graph. You can see that. And now you can see the third graph, which is plotting both of the tick volumes together. And you have lines like this. So this is how Blau's tick volume indicator looks like. So what's the difference between why do you have to use the tick volume indicator? Because it gives you a doubly smoothed moving average, which means that you have a better signal. You have a double smoothed moving average. And secondly, it confirms the price direction. And the formula is 100 multiplied by DMA upticks minus DMA downticks divided by DMA upticks plus DMA downticks. So the moment you see that DMA and the upticks and downticks, you should just know that it is tick volume indicator. And usually the range of the tick volume indicator is from minus 100 to 100. And when we were talking about the K, which is the volatility scale factor, you know that K is usually more than 100. Okay. So the exponential smoothing is calculated over R bars, and the result of the smoothing is again smoothed over the past S bars. So now you know what is the R and S, which is given in the formula, right? So the only thing is that the TVI will be lagged slightly less than half the sum of the two calculation period. So that's why we use tick volume indicator, because it is not a, it gives you very less of the lag as compared to the other indicators which we have been seeing. Now let's talk about what is a volume weighted MACD. Volume weighted MACD. Now MACD is based on the on the difference between two moving averages, right? MACD is always the difference between two moving averages. And to add volume, the closing prices of each day are multiplied by the corresponding volume. So each of the closing day is multiplied by the volume which was there on that day. So when you do that, what happens is that you get the MACD, which is based on the volume. When we were talking about the plain MACD, we were seeing that it is always the difference between the moving averages, right? But when we are talking about volume weighted MACD, we are not just taking the moving average prices or just the closing prices, but we are going to take the closing price multiplied by the volume which happened on that particular day. And each moving average is normalized by the average volume over the same period. So all of the moving averages are normalized. By what factor are you normalizing it? You are normalizing it by the average volume over the same period. The recommended calculation periods are 12 and 26. The standard MACD values. A signal line, also the same as MACD, is the exponentially smoothed VWMACD line using a 0.20 smoothing constant, which is equivalent to about 9 days. So when we were even studying about MACD, we spoke about the concept of the signal line, right? Similarly, when you're talking about the signal line about this particular indicator, which is the volume weighted MACD, you need to keep in mind that the smoothing factor is 0.20, and 0.20 smoothing factor, it consists of nearly like 9 days. And again, here also the recommended periods are 12 and 26 days. Okay. Let's look at this particular chart. Here we have the MACD and we have euro currency future chart over here. And you can see this is how the volume weighted MACD looks like. And whenever there is a volume spike, you can see that the corresponding volume weighted MACD is also taking that into account before giving you a signal. So you can see that the heavier line, if you look at the chart, the heavier line, let me zoom it if you're unable to see. Do you see the heavier line? The one which is above initially. This one is the heavier line. Okay. Yeah. So what you understand by this is that, just a second. Yeah. So what we what we're able to understand by this is that the heavier line is the volume weighted moving MACD, and the thinner line is the signal line. So the thinner line is the signal line and the thicker one is the volume weighted MACD. Okay, so whenever the MACD crosses above the signal line, then you will say that there is a signal for long. Whenever MACD crosses the signal line towards the downside, then you know that in this case you have to basically look for shorting opportunities. That's how the volume weighted MACD usually works. And whenever you're using these indicators, one thing you need to keep in mind is that most of the indicators will work better on higher time frames. So make sure that you are using these indicators on a higher time frame, because if you are going to use them on a higher time frame, then there is going to be a less probability and a less chance for whipsaws to happen in your trading. Okay, all right. Now let's look at variably weighted moving average using volume. So this was again a unique approach which was taken by Kristen Price, and he basically uses this particular indicator which is known as variably weighted moving average. So variably weighted moving average, but the um, special part is that in this moving average they are using volume. Okay, and one thing, the moment you hear about Christian price, or the moment you hear about the variably weighted moving average using volume, the first thing that should come to your mind is outstanding shares. Okay, because this particular indicator is basically talking about the relationship between the number of outstanding shares, the current price, and the volume of the next or the next trade, to create an elastic volume weighted moving average. Again, let's quickly revise what we just saw. We saw that they're talking about the number of outstanding shares, the current price, the volume of the next period. Okay. So then what we do is that we use the difference between the number of outstanding shares and the number of shares being traded. He creates a weighting factor. Number of outstanding shares and the number of shares which are being traded. When you're going to use both of this to create a weighting factor. So if the question comes that when you are using the indicator by Christian Fry, so when you're using the variably weighted moving average using volume, then how do you find out the weighting factor? So the weighting factor is always found by the difference between the number of outstanding shares and the number of shares traded. Okay, that is what is going to give you the weighting factor. The weighting factor causes the previous 10 value to have more importance when fewer shares are traded, and less weight when relatively more shares are traded. So if less shares are traded, then the past information is more important to us, because currently we do not have enough trades which have been shared, so we do not have enough information which can say the same. But in the case that the shares which are traded are a lot before, and now they are less, in that case you are going to take that as more important. But in the case that the shares which are traded now are more as compared to what had happened before, then that will be given less weighted. So that is how it is going to basically function. And the net effect is that the weighted average is more responsive to change when relatively more shares are traded. Okay. So again, EVMA, outstanding shares minus the shares traded, multiplied by EVMA of the previous day plus VT multiplied by C divided by outstanding. So the moment I see outstanding shares, the first thought that comes to my mind is that this formula belongs to Christian Fries. That's the first thing that comes to my mind. Second thing what comes to my mind is the name of the indicator, and that is variably weighted moving average using volume. So I know that a lot of the portion of this chapter is very technical in nature, and it might be really hard for you guys to understand, or it might be really hard for you, even if you're able to understand how to use these indicators, it might be hard to remember these formulas, which is fair. But again, we can't really do anything about it because this can be tested in the exam. But the only thing I can say is that if you've read the entire book, and if you actually understood the concepts, then you will easily be able to tick the MCQs, because now you know about the indicator and you know what the indicator uses in its formulas, and that's what really matters, and that's what is the important part when it comes to this exam. Okay, let's move on. Now we come to substituting open interest for volume using futures. So if you guys are aware with trading in the derivatives market, or let's just talk about futures and let's talk about options in a bit. If you're trading futures, then you know that there's nothing called as volume over here. Here we are going to look at what are open interest, right? And we are going to see open interest. And so whenever we refer to as about the open interest in the futures market, we are again, you can just keep in mind that we are kind of referring to the volume in the futures market only, because if you think about it, it is just the shares or the trades which are outstanding right now. So in the futures market, usually when you go on the futures charts or the indices charts, you can see that volume bars are not being displayed on trading view, and that is the reason why it happens, because it is not right to say that you want to know the volume of the indices or the volume of the futures. Here you can know about the contracts which are open, which is also referred to as the open interest of the future. So that's why I'm saying that when you check the volume of the future and if you check the volume of the stock, there can be a difference between the two. So they market themselves. For example, we have energy, gold, and even interest rates, and these have been in uptrend for years. This causes many of the indicators, especially OBV, to move steadily higher, while it appears to oscillate when applied to stock over the past 10 years. So that really happens, and that's the only reason why that happens is because um again, like I just explained, it is not a stock, it is a future, right? And futures is usually the volume of the future can be different than the volume of the underlying itself. This is the okay, this we see. All right. So it has already been mentioned that futures volume comes in two parts: contract volume and the total volume. Contract volume begins at zero, increases as the contract moves from deferred to the nearby delivery. So there's an expiry date for all the futures contracts, right? So as the delivery date is nearby, then in that case the volume also keeps increasing, or the more people start engaging with the contract as the delivery date keeps coming, right? So contract volume means that it begins at zero, and with each trade that takes place, the contract volume keeps increasing. Whereas now let's see what is open interest. Okay. And one more thing you need to keep in mind, that the contract volume becomes zero by the time of the expiry. Because by the time of expiry, either everyone has sold their options of futures, or people have either, paid it and taken it in delivery. So in that case, there is actually zero volume of the contract. So volume always begins at zero and it always ends at zero as well. You need to keep that in mind. Now let's talk about what is open interest. Open interest also follows a similar pattern. To avoid this pattern, total volume is used instead of contract volume. In the same way futures data shows contract open interest and total open interest, the data varies in the same pattern as volume. However, open interest is much more stable than volume. Similar to volume, open interest increases as market activity increases. Therefore, it reflects the same fundamentals. So open interest is more reliable as compared to volume, all right? And total open interest can be a preferable substitute for volume in many of the indicators. It should be remembered that open interest as well as volume is usually available on downloaded data one a day late. These numbers could be manually downloaded from websites like, let's say, Bloomberg or stuff like that. All right. So you can understand one thing until now, whatever we discussed. The first and most important thing is that the contract volume starts at zero and ends at zero, whereas open interest is something which is more reliable and it does not behave exactly like how the contract volume behaves. Now we have VWAP. VWAP is again a very sought after indicator in the stock market. You can just go on TradingView and type VWAP indicator, and you can just go through that if you want to. Now that is a line which is directly being plotted on the chart. Actually, I'll just show it to you as well because it might be a little bit confusing if I just explain it verbally. Yeah, volume weighted average price. Okay, see again, right now I'm in a forex pair and the VWAP is not opening when I'm trying to trade in this. So that's what I'm saying, that these volume related indicators are not suitable for indices or futures or any sort of what do you say, forex pairs. They are more used for stocks or something that is very fixed in nature. Now here if I search VWAP, then I'm able to plot it. Look at that. See, I'm able to plot it. So I'll just give you a simple tool as to how you can use a VWAP indicator. First thing is that let me remove the upper band, lower band. Let me just keep the VWAP and let me also remove the band fill. I just want to show you how it works. You can see how the candles, whenever the candle is over the VWAP, it is potentially giving you a signal. Let's just assume. Here you can see a very big red candle on the VWAP. So if I would have entered a short over here, I would have made quite some money, right? Here also you can see that a hammer candle went above the VWAP. If you'd entered over here, it would have gone up here also, and it would have gone up. Here there was a sell. If you would have entered over here, and then you could have captured this. So I'm not saying that tomorrow go and start doing this, but I'm just showing you about how powerful the VWAP indicator really is. So VWAP is basically the short form of volume weighted average price. For larger positions, this would return an average price representing how actively the market traded at different levels prices throughout the day. So wherever there's a big candle, or whenever there is a candle which is um, basically the VWAP is in the middle of the candle, or the candle is over the VWAP, in that case you can say that at those price points there was a high volume and there were people were more active to trade. Okay. So this basically, whenever the candle is overlapping on the VWAP, that shows that the most amount of contracts were traded during that time, and the huge volume of trades had taken place at that particular point. Okay. So equally spaced orders that ignore liquidity use TWAP. Okay. So whenever you're having an equally spaced orders and that which basically ignore liquidity, in that case you won't use VWAP, you will use TWAP. Here instead of volume, you use the time. Now let's come to the last topic of this particular chapter, and that is breadth indicators. So when we talk about breadth, or when we talk about the market breadth, that basically means that there is an imbalance between the number of advancing and declining stocks on a given day. So on a given day, a lot of stocks are trending, a lot of stocks are falling. So there are many advancing stocks as well as there are many declining stocks. So there is always an imbalance or a significant gap between the two, right? So it is the percentage of rising stocks to the total number of stocks traded. Market breadth is basically the number of the rising stocks divided by the total number of stocks which are there in the market. In general, more advancing issues should add confidence to an upwards price move in the same way that the volume confirms price. A net increase in the S&P 500 while more issues are declining should generate concern that the upwards move is poorly supported. So just because S&P is increasing, that doesn't mean that overall everything is increasing. You need to always confirm it with the advancing or the declining ratio as well, right? So if a lot of the stocks are advancing on a particular day, then that can be used as a sentiment that you will be looking only for bullish opportunities. But if a lot of stocks are declining on a particular day, then that day you are going to use that, you can keep a bias that today you will only be shorting because the majority of the market is on the shorting direction. So that's the way you are basically going to use the breadth indicators. So the information for advances and declines is published along with stock prices each day. You may also want to you may also want the volume of advancing issues and the volume of declining issues. Both of these values can be found in the Wall Street Journal under the trading activity. Even if you want to check this out on the Indian stocks, you can just go to the NSE website and you'll be able to find it there as well. Okay, so see, this is how it's going to look. You have date, you have total traded, you have advanced decline, and you can see close, whether it changed or it doesn't change. You can see the volume where it increased, and you can also see the open interest as well. So the market breadth indicators are typically used as confirmation of the price direction. Let's look at the table. So the first case is that the market breadth is rising. If the market breadth is rising, that means that the advances are rising as compared to the declines, which means that the price is also, let's say the price is also rising. So since the advances are also increasing and the price is also increasing, we can see that the price is rising. Then we have the advances which are declining because the market breadth is falling and the price is also falling. So that means that the downtrend is confirmed. The third situation is when the advances are increasing, but and the sorry, the third case is the advances are following, but the price is increasing. That means that the price confirmation is not confirmed with the breadth. The fourth one is that the breadth is rising, which means advances are increasing, but the price is falling. So in that case also breadth does not confirm the price drop. So this is how you are going to use the market breadth with respect to the price. The measurement of breadth must relate to what you are trading. If 75% of the stocks in the Dow rise, the S&P small cap index can still be lackluster or declining. Investors shift from small cap to S&P 500 and Dow. So if they're not looking for, let's say, if they are looking for, let's say, safety or some sort of protection of their capital. So breadth of the overall market or the breadth of the large caps is not enough to confirm an upward trend in the small caps. You need to see the overall as well, right? So it is also worth noting that Gerald Appeal, a well-known market analyst and technician, points out that when using breadth, if the best it is best if it is equally weighted, which means a simple count. Now let's separate advancing from declining volume. The most basic of all the techniques for determining market breadth is the advanced decline index, which creates a new series by adding the net of the number of advancing and the declining stocks each day. Unchanged issues are ignored. Advanced decline oscillator is basically advances of today minus declines of today. Advanced decline index is advance minus decline index yesterday plus advances minus declines. So these formulas have to be kept in mind. Advanced decline, when you're talking about the oscillator, it is just advance minus decline. When you are talking about the index, you are going to first take out the index of yesterday and then you are going to add the advances of the today and you're going to remove the declines of today. Okay, next let's go to see what is Sibet's demand index. Sibet's demand index. Now again, this is a smoothed indicator. Okay, and one method that smooths volume by using the total activity of the past 10 days is the Sibet demand index. So Sibet demand index basically takes the activity of the last 10 days and it kind of smoothens it to give you a better signal to whether buy or to whether short. The technique bears a resemblance to the approach used in Wilder's RSI. It can be used as an oscillator with individual daily values or accumulated into an index. When n is equal to 10, the individual days are calculated as the sum of the upside volume divided by the sum of the downside volume. So what is the Sibet's demand index? Sum of the upside volume divided by the sum of the downside volume. The values for upside and downside volume can also be found in Wall Street Journal. Well, let's look n is equal to 5. Okay, n is basically the number of days, and here we have taken n to be 10 because, like we have discussed, that in the case of Sibet's demand index, you are using n to be 10 because you're looking at the activity which has happened over the past 10 days. Okay, now let's start with what is Bolton Tremblay. Bolton Tremblay. Now, this is also again another very important concept when you talk about the breadth indicators. The upside volume divided by downside volume was Sibet's demand index, right? And we also saw how you are going to use the advances and declines. Now, you're going to see what is Bolton Tremblay. Introducing the net advancing stocks compared to the number of stocks that were unchanged, the Bolton Tremblay approach also includes a form of geometric weighing of the results. So using the same advancing and declining concept, when you are taking weighting into the account, then you are going to, the first thing that should come to your mind is Bolton Tremblay, because Bolton Tremblay basically takes the weighting into account and it doesn't take the direct or just the smoothed um, values. It also keeps weighting into account. Okay, so BT or Bolton Tremblay is the daily Bolton Tremblay value, and the BTI is the index which is resulting from accumulating the individual daily values. So Bolton Tremblay of today is basically advancing of today minus declining of today divided by unchanged. Okay, so what is Bolton Tremblay? Advancing minus declining divided by the unchanged values. Advancing minus declining divided by the unchanged values. The moment you see that, you need to keep in mind that that is basically talking about Bolton Tremblay, and here a weighting factor is involved, which is why we are dividing it by the unchanged values. If the Bolton Tremblay is more than 0, then Bolton Tremblay of today is basically Bolton Tremblay of yesterday plus the square root of Bolton Tremblay's today. Again, think about it. BTI is basically the index and BT is just the Bolton Tremblay. So in the cases that the Bolton Tremblay is greater than 0, then the Bolton Tremblay index of today is Bolton Tremblay index of yesterday plus the square root of Bolton Tremblay of today. In the case that Bolton Tremblay is less than 0, then Bolton Tremblay index of today is going to be equal to Bolton Tremblay index of yesterday minus of the square root of Bolton Tremblay of today. Very simple stuff. See, right now these formulas might be a little bit confusing, but if you actually read the book and if you actually try to understand this video and if you watch this video 3-4 times and if you write down these formulas on a page of paper, then it's all going to be really simple. There's nothing for you to worry about. Let's come to Schultz. Now, what did Schultz do and what kind of contribution has Schultz given to the breadth indicator? Schultz chose to look at the advancing stocks only as a percentage of total stocks, which puts in the results of convenient range up to 0 to 100. Schultz basically said that advancing divided by total stocks. That's it. In Bolton Tremblay, we saw advancing minus declining divided by the unchanged, right? And when you are taking just the advancing stock and dividing it by just the total, and there's no question of what the declining stocks are doing, it's just about the advancing and the total stocks, then that should remind you of Schultz. Now we have the Macmillan oscillator. So the Macmillan oscillator is basically it starts with Na, and when you're talking about Na, just keep in mind that it is the net advances. What does net advances mean? It means advances and you remove the declines from it. See, if you just look at this particular formula, you might just get scared and you might be like, what is this? But actually try to understand it. Advances means advances, right? What does net advances mean? That you are removing something from it, you are removing declines from it. That's the way you're supposed to remember this particular formula. So it creates an oscillator by subtracting two smoothed trends. Okay, the Macmillan oscillator basically has the net advances, and once you have the net advances, it creates an oscillator by subtracting two smoothed trends, and the two smoothed trends are 19 as well as 39. Based on the net advances in the manner similar to the MACD, converting the 19 and the 39 the calculation periods into smoothing constants by 2 upon n plus 1. Okay, so you are going to first calculate the net advances in the Macmillan oscillator, and then you are going to subtract it, right, by two smoother trends, and two smoother trends are 19 and 29, and then you are going to use the smoothing constant as 2 upon n plus 1. Okay, looking at the figure 9.7, this particular figure over here, you can see that this is basically a chart of S&P futures, and you have Sibet's demand oscillator in the second panel, and you have up-down volume in the third panel, and the Massillon oscillator in the bottom panel as well. And you can also see that which indicator is more complicated. The Macmillan indicator is more complicated as compared to the Sibet's demand oscillator, and yeah, so just take a moment and try to understand this. But you can see that Macmillan is more realistic, or more giving a proper peak and troughs with along with the price, and it is giving you more um, earlier signals. So that, now let's go to, where are we? Let's go and see what is upside downside ratio. Upside downside ratio. So upside downside ratio is again similar to the Sibet demand index, and you know Sibet demand index was upside volume divided by downside volume, right? So this is what is upside downside ratio. It is very similar to this, but the basically the formula is advancing volume divided by the declining volume instead of what we saw in the Sibet demand. Let me quickly revise that for you. See, it is upside volume by downside volume, and you take a value of n, which is some particular day, whereas in upside downside ratio, it is basically advancing volume divided by the declining volume. Now let's see what is an arms index. Arms index is basically given by Richard Arms, and he explains the relationship between the number of advancing and declining stocks and the up and down volume in the arms index. And again, arms index is also known as the traders index, and this will be tested in your exam. So in the exam, if you have a question which says that what is the other name for traders index, then you should be understanding that it is the arms index. Or if the question is something like what's the formula of traders index, or what's the formula of arms index, then the first thing that should come in your mind is that the advancing stock divided by declining stock divided by advancing volume divided by declining volume. So the formula of the arms index or the traders index is very simple. It is advancing stocks divided by declining stocks overall divided by advancing volume divided by the declining volume. Then we have what we now call a thrust oscillator. So thrust oscillator was given by Tushar Chande, okay, and it uses the same values of Trin. Trin is again traders and arms index right now. Okay, I'll just also underline this so you don't forget these names. Traders index. Yeah. Mhm. Hmm. So thrust oscillator. Now, when we talk about what is thrust oscillator, you look you basically take the same particular formula like you used above, but the only difference is that the oscillator is basically uh, uses the same values of chin but creates a bullish oscillator by multiplying the number of advancing stocks by volume of the advancing stocks and subtracting the comparable declining values and dividing the sum by 2. Advancing stocks multiplied by volume of advancing stock minus declining stock volume of declining stock. Advancing stocks multiplied by the volume of advancing stock, declining stock multiplied by the volume of declining stocks. This is the formula of the TO, which is the thrust oscillator. Advancing stock multiplied by the volume plus declining stock multiplied by the volume divided by advanced same to same minus same to same. Same to same, in the numerator it is a plus, in the denominator it is a minus. And in the case of trim, we saw it is advancing stock divided by the declining stocks and advancing volume divided by the declining volume. But in the case of thrust oscillator, it is advancing stock multiplied by the volume. So volume and the overall thing you are adding and the overall thing you are subtracting. Okay, so again, when you are going to practically use the thrust oscillator, and right now I'm not going to the trading view and showing you how to basically use it because you can do that by yourself. But this again is being used like an oversold or an overbought indicator as well. Okay, and the values of plus 30 minus 30 may be used to identify overbought or oversold um, levels. Just a second. Okay. So plus 30 and minus 30, that's what you are going to use for overbought and oversold. If the value of the thrust indicator is minus 30, then you know that it is basically oversold. And if the value is plus 30, then you know that it is overbought. Okay. Let's come to new highs and lows. There is very little literature on the use of the number of new highs and lows that occur daily. The data are available and can be used in very similar ways to market breadth. The most obvious way to represent this data is by creating a high-low index. So the high-low index is high-low index of yesterday plus the new high minus the new low. Okay. So how do you calculate the high-low index? High-low index of yesterday plus the new high minus the new low. Okay. So NH is basically the new high, new low, and new high, new low basically talks about the 52-week high and the 52-week low. And then if you actually find the HLR ratio, it is basically the summation of new high divided by new high upon new low, and it's a summation. Okay, so you just need to keep this mind: new high low index of yesterday plus new high low minus new high low. Okay, so another method includes the basket of buying a basket of stocks making new highs and selling a basket of stocks which are making new lows. Naturally, that assumes that each stock making a new high will sustain in the direction, and if some stock is making